Welcome to the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is Cameron Mealy, and today we will discuss the economy and performance for the month of July and year to date, and also some of the more recent happenings. Today is August 6th, so a lot has happened since the end of the month. Cam, why don't you start us off with some economic research?
Thank you, Kelly. Good morning, everybody. As Kelly said, today's August 6th. It's about 10:30 in the morning. The market has currently recovered a little bit from the big losses we suffered on Monday. You combine that with Thursday and Friday of last week, and it's been a significantly down market. Basically what's driving that? Well, what's driving that is there's a litany of issues. Right now, there's a lot of global tension out there. The Middle East is a bit of a powder keg. We're seeing a slowing U.S. economy, weaker than expected jobs numbers. There's basically a sense out there that we really have finally started seeing that slowdown that kind of everyone has been expecting. Let's jump into the numbers and kind of see where it all gets proved out. Even though a lot of the numbers are actually not that bad, it's really the trends that we're seeing that is causing a little bit of this concern and confusion. GDP. On July 25th, the Bureau of Economic Analysis reported that according to its advanced estimate, second quarter GDP increased at an annualized rate of 2.8%. This is a healthy number and significantly above the 1.4% increase in the first quarter. Interesting to note about GDP gains, it really was the strong consumer that continues to drive GDP. According to the Bureau of Labor Statistics, about 70% of the GDP gain in the second quarter was driven by consumer spending. Now we turn to the jobs report. On August 2nd, the Bureau of Labor Statistics reported that the U.S. added a disappointing 114,000 jobs in July, and the unemployment rate ticked up to 4.3%. That's one of the weakest job reports we've seen coming out of the post-COVID era, so that obviously raised some concerns. Let's look at the inflation and what's going on in inflation. The Personal Consumption Expenditure Index, this is the Fed's leading gauge of inflation. On July 26th, the Bureau of Economic Analysis reported that Personal Consumption Expenditure Index increased to 0.1% in the month of June. For the last 12 months ending June, the index is up 2.5%. This compares to 2.6% in May, 2.7% in April and March. Producer Price Index. On July 12th, the Bureau of Labor Statistics reported the Producer Price Index increased 0.2% in June. On a year-over-year basis, the index is up 2.6%. This is the largest year-over-year increase since the index was up 2.7% in March of 2023. Last inflation number, Consumer Price Index. On July 11th, Bureau of Labor Statistics also reported that the Consumer Price Index fell 0.1% in June, and on a year-over-year basis, the index is up 3%. So GDP still looks strong. The employment situation looks weak. Consumer spending is still strong. But obviously, as employment goes, consumer spending is going to go. What's interesting is we really are starting to see inflation come under control. It's not where the Fed wants it yet, but it has been trending in the right direction. It's been trending softer. So this really begs the question of, is the Federal Reserve ready to cut the Fed funds rate? On August 1st, the Bank of England cut its target interest rate by 25 basis points. We now have 5 central banks in the developed world that have started easing. Switzerland, Canada, Sweden, the Eurozone, and the UK. The next Fed meeting is September 17th and 18th. If we continue to see this inflation rate in the 2 to 3%, we continue to see the market struggle, we see another disappointing jobs number, my sense is that the Fed will cut Fed funds rate by 25 basis points, probably in September, and probably another cut again, unless we see a dramatic improvement or change, probably another 25% in December.
Yeah, I mean, the trend is right on inflation. Continue to see the numbers. Once we get into August numbers, September numbers, going to get through the wonky June, July numbers. And hey, if it's there, the Fed probably starts to cut. Short-term rates are definitely higher than they need to be. If you look at, if inflation is going to stick around 3-ish, I mean, the Fed wants to be at 2. I don't think it's really going to get there for a while. I think we're going to hover around 3 plus or minus. Inflation is around 3. That means short term, the Fed funds rate should be in that, 3 to 4% range, which ultimately going from 5.5, where it's at now, yeah, we're going to see some cuts at some point. The Fed doesn't want to move too quickly because it's hard to go back the other direction. GDP, kind of better than expected. Things are slowing, but we're not falling off a cliff. There are areas of the economy that are doing fine, other areas that are struggling. In higher interest rates, that hurts your more leveraged companies, companies with a lot of debt.
Well, and frankly, if you look at the earnings for the second quarter, by and large, for your kind of standard brick and mortar companies, the earnings have been pretty good.
Yeah.
It's just been the technology companies where the valuations have gotten so ahead of themselves that have come in a little bit disappointing, and that's really led to a lot of this down phase.
The dislocation in the market, a lot of it was driven by the big tech stocks.
They're basically dragging down everything.
Obviously their prices got way ahead of themselves based on the hopes of AI. Where that goes, who knows? But prices were driven up, and now, how they actually gonna make money on it? Nobody still knows that. AI is a real thing, but how it's going to be capitalized, who knows? Big picture, and really let's start talking about performance and returns, what's been happening. So at the end of the month, so we're going to look at end of July, and then I'll compare that to where we're at today. For the month of July, the S&P was up 1.13%. The Dow was up 4.41. The NASDAQ was actually, through the end of July, was down 0.75. So already in July, we were starting to see that rotation. You're starting to see weakness in the tech stocks, in the NASDAQ, which was, that's why you have such a big underperformance in the S&P and the Dow. The Dow's been the laggard, and now all of a sudden the Dow's, the leader. In the Russell 2000, which is small caps, had a huge month of July, up 10.1%. So things got a little frothy in the small cap arena. The international markets, the EAFE, 2.89% for the month, pretty strong there. Emerging markets actually down 0.14. Bond index, because interest rates, longer-term interest rates actually came down in July, up 2.34. Looking at year-to-date, so through the end of the month, the S&P 500 for the year was up 15.78. As Cameron mentioned, we've started this month off on a pretty rocky footing, big correction. So through August 5th, through yesterday, the S&P is now only up 8.73%. So the S&P shaved off about 7%. Pretty healthy correction there. The Dow Jones through the end of the month was up 8.37. Now is up 2.69. So that shaved off a little less than 6%. The NASDAQ was up 17.24 through July. Now it's only up 7.92, so a little less than 10%. And then the Russell 2000, what we say was up 10% last month. Year to date, it's now up 11.22%. I'm sorry,
through July.
Through July, it was up 11.22%, so it wasn't doing anything pretty much before July, did everything in July, and now we're up 0.6. So it gave back everything that it made in July.
Correction, the Russell
2000. So big correction there. I do not have the current international numbers, unfortunately. I just didn't have those at my fingertips this morning. Our portfolios, the growth with income portfolio, for July, we were up 2.4%, so a nice month there. Year to date, up 11.8. During the month, Lennar, a home builder, up 18%. Iron Mountain was up 14%. Raytheon up 17%. J&J up 8%. So no tech names leading the pack there. Laggards, Toyota was down 5.6. Disney down 5. NVIDIA down 5. And Honeywell down 4. Year to date, NVIDIA, even after this big correction, so through the end of the month, NVIDIA was still up 136%. And I think it dropped another 20% yesterday, or 15% yesterday. So, year to date, still up a lot. Iron Mountain up 48% through the end of the month. Raytheon up 41%. Exxon up 21%. Oil prices did weaken a little bit yesterday, so we saw a little bit, pretty much everything went down yesterday.
Well, a slowing economy is going to lead to lower oil prices because of lower demand.
Exactly. So year to date, after yesterday, growth of income now only up 7.12%. So kind of, we lost about 4%, a little better than the indexes. Dividend yield, July was up 4%, so a nice month for dividend yield in July. Year to date, it was up 9.5. Through yesterday, now it's only up 605. So what's that, about 3.5% it gave up yesterday. Through July, Blackstone was still a big winner, up 15.5%. U.S. Bank was up 13. Alliant Energy was up 10.3. Merck gave some back in July, down 9%. Waste Management, which we actually got out of, was down 5% last month. The UPS down 4.7. Still big gainers in there. Eaton, which we sold at the end of the month, year to date we had made 27% in there. Packaging Corp, we were up 24. Prudential up 23. Southern Company up 21%. McDonald's still lagging for the year. UPS down, McDonald's down 9% for the year. UPS down about 15% for the year. Appreciation with income, kind of the portfolio that's been leading the pack for us this year. July up 3%, so a nice July. Year to date was up 16.2. It did give up about 6%, so now only up 10.04 year to date. Philip Morris, a big mover in there that we only added halfway through the month. That's up 13.7%. Pinnacle West up 12. Union Pacific up 9. Once again, Merck on the laggard side in July. Merck down 9. Hewlett Packard down 6. Bunge Corp down 1. Year to date, Equitable still up 32%. JP Morgan up 27. Energy Transfer Partners up 23. Price potential, had a nice bounce. But this portfolio has been struggling. We haven't given up on it yet. July had a nice bounce, up 3.7%, which was pretty much all its gains year to date. Now we're basically back to even again after yesterday. We're slightly in the red, down 0.39. In July, Charles River Labs up 18%, Centene up 16, Graphic Packaging up 15, Integra Life Sciences gave up 15% last month. Google gave up 6, Arch Capital gave up 5. Year-to-date gainers, though, Arch Capital still up 28%, Allstate up 24, Cigna up 17. So we'll continue to, follow our methodology in there, and I think, ultimately that portfolio will be fine. It's just, we have a really bad year where historically it's a good portfolio, but bad, we're not losing money, just not making anything in there. Small cap portfolio, we talked about the Russell 2000, which is small caps, kind of a huge month last month. Our small cap portfolio up 8%, so we lagged a little bit. Year to date, we were up 19 though through the end of the month. After, the shellacking of small caps yesterday, we are still up 8.15 for the year, so we're still doing pretty well in there. In July, Commvault was up 25%, PJT Partners up 23, Village Supermarket up 21%, laggards, Informatica down 22%, Camtech was down 16% last month, Dutch Brothers down 7.6. Year to date, IESE still in the portfolio, up 91% in there. U.S. Lime and Minerals up 85% there. Year to date, Graham Corp up 72, Camtech still up 54, even though we gave back 16 last month. So that's kind of where we're at these days. I think we held up pretty well. The big picture, I always say volatility's around the corner. Well, we saw it yesterday. The NASDAQ definitely in correction territory, more than 10% move down, off its highs. The S&P and Dow, S&P is pushing correction territory. The Dow is not. A lot of this is the pull forward with AI. Pushed a lot of stocks up, which pushed the index up. Now some of the air's coming out of that a little bit. The rest of, kind of our more fundamentally sound companies, they're getting through it just fine. I don't see us falling off a cliff. The economy is slowing a bit, but it's not falling off. That also not falling off a cliff. It's just, hey, volatility is real. We're in that time of the year, a couple months ahead of an election. That's when the volatility tends to kick in. August, September tend to be a little bit more volatile. Probably have some more ahead of us. Could we see lower lows over the upcoming weeks? Very possible. Will we be at these levels at the end of the year? I don't believe so. I think we'll be, farther ahead than where we're at now, if not further ahead than where we were at the end of last month.
This harkens back to, if we think about, don't have the exact numbers on me, but if we think about March of 2021 and COVID, the market basically was down 30%. And fast forward less than a year later, the market recovered all of the losses and was gaining new highs.
Right.
We are at highs. We are higher than we were during the COVID years. The market has been, moving up aggressively because of some of these technology stocks. But the thing to remember is this is a blip. And if you fast forward 2 years from now, I'm quite confident the market will be at highs we're not seeing today. Fast forward 3 years from now, 4 years from now, 5 years from now. The key with investing is you got to stay with it. And if you need cash and you've told us about it, we've got you in fixed income. We've got you sitting in the money market for immediate cash needs. You know, we're watching that side of your financial picture. But the equities is where you make real returns year over year consistently by staying in them. So you just got to stay in it. You got to ignore the noise. If you can't stand seeing the Dow down 1,000 points, turn your TV off.
Yeah, it's going to be noisy, obviously, going into the election. The geopolitical issues, you know, those will cause some volatility. Long term, it's not gonna hurt us. We're in a transitional period. Rates are going to come down. You know, ultimately at some point, we're seeing some softening there, but you know, the volatility is going to be here for a while. But it's not going to be.
We'll get through it.
It's not going to be too brutal. Our exposure to the tech is not high, so I think we're going to get through pretty unscathed.
Yeah, you just think about all the corrections, maybe not classic corrections, but you've seen about all the ugly days we've seen. Technology, tech wreck in 99, 2000, housing crisis in 2008, 2009, with COVID, you know, now today with these AI valuations. You know, the one thing about the market is there's always volatility. There are always points where things look really scary. And if you fast forward 12 months, 18 months, 24 months, we've gotten out of it. We've gotten it out of it unscathed. You just don't want to make rash decisions when the market's down because that's when investors get hurt.
Exactly.
So, well, thank you very much for the trust you place in us at Ellsworth Advisors. We hope you have a great month. We'll talk to you in another 30 days. If you need us, please feel free to give us a call.
Thank you.